听见资本本期视频为您带来的是摩根大通在4月10日录制的内容，主题为解放日后的亚洲。市场刚刚经历了一场过山车，全因为反复无常的美国关税政策。1周前感觉全球贸易体系要崩了，这周虽然暂时缓和，但悬在中国头上的巨额关税，还有对其他亚洲经济体的潜在威胁，依然是巨大的达摩克利斯之剑。这不仅仅是市场波动，这可能意味着美国经济明年陷入衰退，更是对过去几十年全球化模式的颠覆。特别是依赖出口的亚洲经济体正面临生存考验。具体到亚洲，冲击来自好几个方面：全球需求放缓，中国因为出口受阻，可能将过剩产能倾销到邻国，以及对亚洲长期增长模式的可持续性质疑。短期内甚至可能有转口贸易的扭曲机会，但这风险极高，中期来看前景不妙。为了应对，亚洲各国央行很可能要大幅降息，财政政策也会在有空间的国家发力。市场已经提前反映亚洲利率成了避险赢家，但调整或许还没到位。不过真正的风险点在哪里？人民币会否大幅贬值并拖累整个区域？各国与美国的贸易谈判结果如何？甚至会不会有强制性的汇率协议出现？这些都可能引爆新的市场动荡。接下来是英文会议的全部内容。如果您需要我的投研助理人工加 AI 辅助校对的中文文本，您可以在频道的 Patreon 上获取。
Hello and welcome to this At Any Rate podcast. This is the inaugural edition of a podcast that centers on all things Asia, macro and markets. I'm your host, Arindam Sandilia, head of Asia Macro Strategy for JP Morgan. And I have the pleasure today of being joined by my colleague Sajid Chinoy, our chief Asia economist and head of India economics for the bank. Sajid, welcome to the podcast. Now, given that this is
Thank you.
Yeah, sure. Now, given that this is an Asia-focused podcast, it seems only fitting that we begin with a Chinese saying, may you live in interesting times. Well, a wish fulfilled, I'd say. Hard to deny that it's been a more quote-unquote interesting and wilder ride in markets than many may have preferred. At this time last week, it felt like the world as we knew it had ended after President Trump's imposition of double-digit reciprocal tariffs across most countries in the region, which then only escalated via several rounds of tit-for-tat retaliatory tariffs between US and China. But Wednesday this week brought a much welcome relief in the form of a 90-day reprieve on those reciprocal tariffs above 10%, as countries ostensibly seek to negotiate trade deals with the US. But for us sitting here in Asia, the Damocles sword of 100% plus tariffs on China continues to hang over our heads. Needless to say, macro views and market prices have both been in tremendous flux over these past few days, as is to be expected when VIX had shot up to 60% at one stage, and when multi-sigma moves were unfolding several times a day on an intraday basis across many markets. So first, to hold our collective hands and soothe our frayed nerves, and then to light the path forward on macro and policy, I have just the man with me. Sajid, please help us out here before we unpack the implications of all these events for Asian macro. Could you just maybe take 2 minutes to set the stage for us in terms of how the global econ views are evolving in the wake of this on-off tariff announcements over the past week or so?
Thank you, Arindam. This truly has been a seminal week. It reminds me of the week after the global financial crisis and the first week of COVID. So we're living in very interesting times. Let's step back and try and understand the global picture. You alluded to this a week ago. What was Liberation Day in the US was a tariff gut punch day for the rest of the world. And just to put some numbers on the table, effective tariffs in the US were about 2.3% in 2024 before Trump's inauguration. On April 2nd last week, that jumped tenfold to 23.3%, right? So this was an enormous increase in effective tariff rates. Yeah, and there were two implications of this. First, this constituted the largest tax increase for U.S. consumers since the 1968 Tax Revenue Act, right? And this was going to squeeze purchasing power for U.S. households. It also meant that the trade-related uncertainty was going to depress investment. And it was no surprising, therefore, that our U.S. economists essentially penciled in a U.S. recession for 2025. But I would argue that was just a cyclical impact. There was something more ominous for the rest of the world. And that was, again, what you alluded to, that this was an assault on globalization as we knew it. This was an upending of the global trading system. The concerns were U.S.-China trade would, effectively break down. the US was building a massive tariff wall around itself. There would be pressure on other countries to impose tariffs on Chinese exports. So global trade would be completely recalibrated, and that would be to the detriment of emerging markets, whose lifeline the last 30 years really has been flourishing and riding on global trade. So that was the bigger concern. Now, a week later, we've got some reprieve. As you alluded to, effective tariffs in the US have come down to 10% for all countries, except that China tariffs are now up to 125%. I know markets are heaving a sigh of relief today, but we need to be careful here about, the headwinds that still confront us. First, the fact is, if you statically look at the numbers, the fact that Chinese tariffs are at 125% means if trading volumes don't change, the effective tariffs in the US actually goes up to 25%. It's even higher than what we saw last week. But of course, that's a static concept. I think in reality, what's going to happen is exports from China to the US are likely to dramatically shrink, right? But then you could see all sorts of supply chain problems to the extent that you don't get substitutes either in the US or in third countries. Now, as a thought experiment, let's assume there are no China exports to the US at all. Those volumes shrink to zero. The effective tariff rate in the US would still be 12%. It would still be, almost 6 times as large as existed last year. And that, is a substantial tax increase of about $300 billion in US households. So I guess the broader point I want to make is that this is still a significant headwind to the US. Odds are that activity will still contract later this year. I'll end by saying that this will mean that from a Fed's perspective, we've always been speaking about this asymmetric reaction function, that if growth comes under hit, if the labor market begins to crack, the Fed will look through a near-term increase in inflation. So we now, the odds are the Fed will start cutting from September and take the terminal route to 3%. So we've got some relief from Liberation Day, but it's too early to claim victory.
Okay, brilliant. So with that in hand, that's a nice segue into the Asia discussion, which is what we're here for. How you're thinking about the transmission of that global view to your countries? What are the channels of transmission to Asian growth? And tricky question, but have you made any changes to your growth forecasts yet? What is the state of play there?
Thanks, Arundam. I think it's important to separate the channels of transmission. I think there are 3. Right? There's a cyclical element, there's a Chinese overcapacity channel, and there's a more structural channel. But I think the first thing is what happens to China, right? Because China is now facing a 125% tariff from the US. When tariffs went up by 54%, our China team added much more fiscal stimulus to the tune of 0.7% of GDP. And despite that, Chinese growth this year was slated to slow to 4.4%. Now, there's another 50% increase of tariffs on China above and beyond what we thought. So I think the pressures on China are going to increase. And what will be very important to monitor is how does China respond, both from a retaliation perspective, but also from a, how does policy buffer the shock? Will we see even more fiscal? Will the currency begin to depreciate more? So I think that's kind of the elephant in the room. Now, for the rest of EMAX, emerging Asia, ex-India and China, there's clearly a cyclical component. I think it's important to point out these are small, open economies. Exports to GDP are very elevated. They rely on exports. And 45% of their export basket is directed to the US and China. So if we're still worried about a US recession, maybe a milder recession, but a recession in 2025, and we're worried that the growth risks to China are even lower, then you're going to have that cyclical hit to EMAX, which we have to be very cognizant of. A. B, because you've now got, Chinese tariffs at such elevated levels, more and more Chinese overcapacity, will find its way to other emerging markets, and Asia will be in the front lines of that. This is a story we've been telling for the last 2 years, that many Asian economies have seen Chinese imports come flooding in, and I think that process simply gets accentuated. So there are these 2 cyclical components, of global growth slowing, possible US recession, China slowing, and Chinese overcapacity coming in. But again, I go back to the broader issue that there's a structural fork in the road that the Asian growth model, faces. If these tariffs are eventually rolled back and we get some semblance of the globalization we had last year, Asia can get away. But if you get a disruption to global trade, right, then we will need to ask more fundamental questions about whether this Asian growth model that's predicated on, very high levels of export rates can sustain in this new deglobalized and economically balkanized world. I'll just make one point, Arindam, a final point. It's important to separate what happens 3 quarters from now with what happens right now. The large tariff differential between China and the rest of Asia means the incentives to transship through third countries in Asia, through the Vietnams and Malaysias of this world, are higher than ever before. So one key variable is going to be can China get around this by transshipping through Asian economies, and how will the US administration identify that or react to that? And B, Secretary Bessent spoke about that the 10% is a floor, and he spoke about last week's tariffs being a ceiling. So if every economy knows that this is the floor, the 10%, and tariffs could get higher going forward, you will have more front loading of exports to the US like we saw in the first quarter. So in the near term, paradoxically, Asia could get a growth tailwind from some of this front loading, from some of this transshipment. But of course, the medium term looks much more ominous.
Yeah, the transshipment issue is an interesting one. I was in the US last week speaking to clients, and it did not feel to me like, maybe it's the geography and you're not so focused on trade in the way that we are sitting in Asia, but transshipment was not front and center of their thinking. And maybe if there's adverse news on this front, it could catch segments of the market maybe a little unawares. But we've talked about growth. Let's come to policy. How do you think Asian policymakers react to these events? Are there any significant differences that you see across our countries in the region, who can and cannot deploy certain policy tools, or do you think this is kind of a broad-based set of counter-cyclical policy that's going to be used?
Yes, Arundham, thank you. I think policy is going to be front and center in 2025. We've been writing for the last 6 months that Asia enters 2025 on a relatively weak wicket because we're still below our pre-pandemic path. There's still slack in many economies, and the latest set of developments around the world have meant we've made large markdowns to our growth forecasts this week. Now, how does policy respond? Another view we've held for a long time is monetary policy has a lot of space in many economies because inflation has come off sharply in Asia, given the slack in many economies. But nominal policy rates could not follow inflation down because until the Fed began easing last year, they were caught in the classical trilemma. So real interest rates in many parts of the region are actually very elevated given the slack in these economies and given the cyclical risks or the structural risks that await many of these Asian economies. So our view for a long time has been that monetary policy will do the heavy lifting. And over the last week, we've simply added more monetary easing across the board. We now expect long cycles of monetary easing in Korea, in India, in Thailand, in Philippines. We see some easing in Singapore, possibly even in Malaysia, and even in a country like Taiwan, where output gaps are positive. If you get a sharp global recession, Taiwan is very levered to the global cycle, and you could see easing later in the year. So we continue to believe that monetary policy will be the instrument of choice. We have more conviction now that you get longer easing cycles in many of these economies. But I also want to add the element of fiscal policy here, because given the growth risks that await Asia, this is not a monetary or fiscal. This will have to be a monetary and fiscal wherever the space exists. Now, we're seeing that in China, that fiscal policy there is the first line of defense. So we expect that to continue in China. The augmented deficit this year is already slated to go up by 1.5% of GDP. My suspicion is we'll see more of that after the latest announcements. In Korea, we now expect a couple of supplementary budgets. Again, deficits going up almost 1.5% of GDP. We think Singapore has some space. We think Indonesia may do more fiscal. So we're going to be in an environment where fiscal, monetary both come into play. Monetary is the instrument of choice. Where you have fiscal space, you will use it. And where you don't have fiscal space, or there's a disinclination to use fiscal, like in an India, or fiscal space is constrained, like in a Malaysia or a Thailand, then, even more heavy lifting has to be done by monetary. But I think policy will have to be a key player this year to try and buffer the growth shock. Arindam, thank you for that. I want to now turn this back to you. So if you take that view as a starting point, that monetary policy will be the instrument of choice, is it straightforward, Arindam, to then extrapolate that, in markets we need to receive rates and buy bonds?
Hey, Sajid, yes. I think the one-line simple answer is absolutely yes. The epiphany of 2025 for us so far is that, markets had chosen FX, in particular, being bullish on dollars versus CNY and other correlated Asian currencies as the instrument of choice for playing Trump tariffs. And it's turned out that the real winner has been Asian rates. On average, 5-year yields in the region, ex-China, have fallen about 40 basis points since the start of the year, which is a massive adjustment for such a low-vol market like Asia, as money market curves have become more comfortable with pricing deeper rate-cutting cycles for the reasons that you described, but also crucially the loosening of last year's US dollar/FX stability constraints had handcuffed so many central banks, and that's kind of out of the way now. So the big question from here is, have we adjusted enough? We think that the answer is no. And obviously you continue to have these misgivings about both cyclical and secular growth prospects for the region, which is a big part of this thought process. But just in terms of valuations as well, we feel like market-priced real terminal rates remain much too high for that sort of growth anxiety. And we also feel like, in this world where you're not really constrained by slack, there is inadequate risk premium in our IRS curve pricing relative to any notion of neutral, especially when you compare to previous down cycles in global activity, right? So, if you look at a curve like Korea, for instance, we don't even price in as many rate cuts as your team is expecting. Whereas usually in deeply pessimistic markets, you tend to see market pricing run well ahead of economist expectations. So at this stage, we are bullish a broad range of rate markets in EM Asia, typically like the front end of the curve, especially in North Asia, which is bang in the eye of the tariff storm. So China, Korea, Taiwan, Thailand, India, Philippines, bullish stances across most of those markets. At the long end of yield curves, I'd have to say that we have been much more selective, stayed mostly close to home. There's a definite bias for greater fiscal easing, as you described, and that should in turn lead to steepening stance from extremely flat levels of curves. But I'd have to caveat that by saying that it's not always an easy trend to play in generally flush liquidity, export surplus Asian markets. But we did get some news this week that Korean bonds inclusion in the Weekday index has now been delayed by 5 or 6 months to April of next year, as opposed to November this year. That now creates a demand-supply imbalance for long-end bonds in Korea. So given that alpha factor, that's where we think this sort of fiscal-led long-end steepening is perhaps most likely to play out in a visible fashion.
Fair enough. And then let's turn to FX. What about Asian FX, though? I mean, the dollar seems to be behaving differently this time around vis-a-vis 2018, 2019. In your view, how does that shade Asian FX? And are there any particular currencies that you have strong views on?
Yes, I think that's a fair question. And if we sit down to discuss the broader dollar dynamics here, that'll be an entire podcast by itself. But we've seen that dollar G3 has been coming off through this period of tariff stress. Generally, you think that Asian FX partially takes direction from what the Euro and Yen are doing and partially from CNY. So this period has been sort of a control experiment. When Euro and Yen strengthen, but the CNY is under pressure, what does Asian FX do? And net, what we found is that Asian FX takes its cue from CNY more than G3. But obviously, the fact that DXY has been under pressure reduces the velocity at which Asian FX can weaken. Dollar CNH, I think, is very interesting here, given the dynamics of the CNY fixing. The PBOC seems to be signaling a regime shift in the CNY. Generally, these phases tend to last 2 to 3 months. So we will see how long this period of creep higher in fixings last. But we did break 740 24 hours ago. And I think, so long as these tariff overhangs on China stay in place, markets will be looking to continue extending that trend higher, possibly towards 745, 750, and then maybe reassess. And I don't think Asian FX on the whole will be able to escape the gravitational pull of CNY in this climate. So risk premia in our currencies, I think, needs to expand. We generally like to be more bearish on the North Asian, more trade-exposed part of the bloc. So these would be currencies like Thailand, Singapore, in addition to CNY. South Asia, again, we are mostly staying away from because there is a push and a pull. You do have some degree of tariff insularity because these tend to be more closed, domestic-oriented economies. But on the other hand, in a generally challenged global risk climate, these traditional high yielders tend to suffer certain, some weakness. So there's a push and a pull, and it's not clear where South Asia goes from here. But I think the North Asian piece is a little clearer on the weakness side. So let's wrap up with a very quick one, Sajid. Very briefly, if you had to flag, the single biggest risk to your views or one significant factor that you're watching that can be very material for your forecasts, what would that be?
And then two quick things. One, to pick up from where you left off. If the CNY were to depreciate sharply and China uses that as a response to the tariffs, as you rightly said, that's going to drag Asian FX down with it. Now, the question is, will that impede monetary policy easing? Will those currency pressures impede monetary policy easing in some countries? And then does that mean that those economies either have to do more fiscal or will have to, take a larger growth shock? So that's one thing we're watching closely. The second is, of course, and this is perhaps obvious, how the trade negotiations between many Asian countries go with the US. We know Japan, Korea, India, Vietnam, Thailand are all in active negotiation. And, if those negotiations fail, the implication yesterday was that tariff rates go back to the rates that we saw on Liberation Day. So that's going to crucially impact how we think about the region. Can you get successful negotiations? Can tariff rates go to 10% or even below 10%? Or will that fail and these rates go back up to last week's levels? Will have a crucial bearing on Asia. So both these factors, I think, will be material to our views going forward. But Arundam, let me wrap up by asking same question for you. What is the single biggest risk factor that you're watching for Asian fixed income markets?
Okay, I'll take a cue from your book and come up with two. First is the CNY fixing, and you and I are on the same page on that. The second, I don't think the market is talking about this enough. Non-tariff barriers were a key part of the reciprocal tariff calculus. One of those non-tariff barrier variables is FX policy. To the extent that FX policy is brought to bear in trade negotiations, are any surplus North Asians that have historically traded on the cheap side of fair value forced to revalue their currencies, i.e. some version of the Mar-a-Lago Accord that the market's been talking about? Does that apply to any part of Asia at all, which will run counter to the direction of the dollar CNY trend? And I think that'll upset some Asian FX views in the region. So let's leave it there for this edition of the podcast, folks. We have unpacked a lot in a short amount of time. Sajid, thanks for joining us on this podcast on a India public holiday. To our audience for listening in, hope to see you in a fortnight in hopefully less interesting circumstances. Be well and have a restful weekend ahead.